to Go Cash Flow Investors, Go for Cash Flow Investors, and today we are going to do Q&A. So for everybody that is a member, make sure you attend these. We do these every single week on Mondays, Wednesdays, and Thursdays. Fridays, and at 5:30. And today we have a bunch of questions. We're going to address those, and then we're going to go through a analysis on a property. So this should be fun. So this is a property we're going to kind of do an analysis on, which is a mastery style analysis. Is this a good deal, okay deal, bad deal, or a great deal? Right? So that's the analysis that we're going to do on this particular property. And this is a property, if somebody from Mastery Gold or Platinum wants it. So I just put it out there today, got a bunch of responses. So I thought, why not we go through this analysis and we'll go through it together. So before we get into that, I want to get through a few questions that were asked, and then we'll get into the property analysis. So the first question was, I'm trying to buy a property and the husband is gone. So I don't know if by gone, this person means that the husband is expired, meaning no longer, if that's what they're saying, or if they're saying that the husband is no longer in the picture. In terms of like a divorce type of situation. I don't know. But the wife is around, and the wife says, well, I don't care. The property can go into a foreclosure. Now, what do I do? Because I think this is a huge money maker. So you have a pencil here somewhere, man, if you can find it in the meantime.
The pen for the smartphone.
Yeah.
Yeah.
Oh, here it is. Okay, great. So so the question is, well, what do I do? So it's going to depend on what the situation is. I'm assuming by gone meaning that the husband is passed away. Because if the husband is passed away, then the wife at the end of the day, most likely is going to be the one who inherits the property. And so if that's the case in this case, and let's just say there is a loan on the property and it's in foreclosure, right? So this person is basically trying to find out, the wife's thing is that, hey, I don't care, right? Depending on how much equity you have. I don't know if you have equity in the property or not. If you're saying that this is going to be a very profitable deal, then I'm assuming there is equity in the property. Probably the property needs some work. If there is equity in the property, legitimately, you can basically make a deal with the wife that, hey, listen, I'm interested, I'm an investor, I'd like to buy the property, and maybe we can give you some sort of a cash for keys sort of situation. You're totally good to do that if there is legitimately equity in the property. Now, if the wife just says, well, hey, I don't care, I'm not going to do anything, period, that's it. There's nothing really you can do. If she's just going to let it go to auction, if you've seen the property from the inside, I would try to partner up. And if you think there is a lot of equity, maybe buy the property at auction with somebody. I mean, if you're from Mastery, make sure you contact us. Maybe we can all figure out who you can buy the property with, and you'll make some money out of it also. If there's that much equity, if you've seen the property, if that's the situation. But otherwise, you can always offer the wife some sort of an incentive if there's equity in the property, a little bit of money. And if you don't know how to do it, reach out to us and we'll help you with it, because this is a property you could possibly do a subject to. You could basically catch up the mortgage, do a subject to for the remaining amount, as long as the amount is caught up, depending on how much is owed and what is the reinstatement amount that is owed to the bank. So you have a variety of choices. Just the only thing is you got to get in good graces with the wife and maybe offering her a little bit of money. Now, understand, if it's a short sale and if it's going to be a deal that's going to be upside down, you cannot offer her a inducement, meaning saying that I'll give you cash for keys, right? So that would not be legal. Now, can you buy stuff that is in the house? Sure. Right? If there's something of value in the house, be it refrigerator, be it appliances, be it whatever, say, hey, I'll buy these from you legitimately. And at the time of sale, you can just do a separate purchase and sales contract. That's okay. But what you can't do is you can't basically have an inducement in terms of, that, well, wink, wink, nod, nod, the bank's not going to find out and we're just going to do I'll just slip you some money. I would not I would not suggest that to you. But definitely, if you can get the wife to cooperate in some manner, definitely you can make that happen. Second question was, I see many people pushing multifamily now. What are your thoughts on why it's trending towards multifamily recently? It's actually not trending towards multifamily recently. What a lot of people are pushing with multifamilies, here's the thing, right? With multifamilies, the biggest deal is this, that most people, and this is 99.9% of all gurus in the multifamily space, or people who are trying to do multifamily, what basically multifamily is presented as is this nirvana, where you're going to buy this bigger multi-unit building and supposedly it's going to make you a lot of cash flow, right? Guys, listen, at the end of the day, real estate is all about what price do you pay for the property, right? That's what this is about at the end of the day, right? So if you have, let's say, $5,000, $10,000, 20, 30, $40,000, right? Can you play in the multifamily space? Sure. You'll be like a, 1/600th of a partner in the little amount of money you're going to put up. What is your return going to be? Your return is going to be almost zilch, right? If you don't have money. Now, if you have some money and you can put up $100,000, $200,000, can you get decent return? Sure. But most multifamily space right now, it is overpriced. It is overpriced obscenely to the most extent. Now, does that mean there are no deals out there in the multifamily space? No, of course not. Somebody is finding a deal somewhere, right? So if there is a phenomenal deal out there, sure, you can make a lot of money doing anything. But guys, listen, this has nothing, and I promise you this, I will take any amount of bet on this, right? Any amount, right? You put up the money, I put up the money. Literally, if you say, Andrew, I'll take 100,000 on bet, I will bet you 100,000 bucks. Point blank. You give me 10 investors and they do what I'm suggesting, which is smaller properties to begin with, and you take 10 investors. I promise you, I can get the 10 investors, 8 out of them will become multimillionaires in a matter of 2 to 3 years. 100%, as long as they follow the system, right? With multifamilies, it is not going to happen. And here's why. It's not that multifamily is a phenomenal way to invest. There's nothing wrong with it, right? The problem is it's just a flip. In 99.9% of cases, when you're raising capital, when you're doing basically a syndication, what are you doing? You're gathering money from a bunch of people, putting it together, and then you're taking that money and going and putting it down on a bigger deal. And then you have an exit plan, 3 years, 5 years. That's generally what it is, right? Nothing wrong with it. It's just a fancy form of a flip, right? And if you're going to do all of that work, my point to you is just do a flip, right? You'll be a lot more lucrative in a lot shorter amount of time. Now, does that mean you shouldn't be doing multifamily? That's not what I'm saying. What I'm saying is that 99.9999% of the deals right now that are being done, people are overpaying for multifamily. Why is it being promoted so hard? Because people are trying to raise money because that's what everybody's buying multifamily, so I'm going to buy multifamily, which makes no sense. To me, unless it's a deal, why the heck are you really buying that type of property, right? That's what you have to think about is, does this make sense for me? And multifamily is very exciting, very, you talk about big numbers. That has nothing to do with profitability. I promise you, right? That if I took, 50, 60, 100, 150 people from Mastery that have cash flows in excess of $20,000, $30,000, you go out and actually find multifamily people that'll actually show you their personal net cash flow every single month. I will tell you 100%, people from Mastery 100% will beat the numbers that you will ever achieve in multifamily. Not because it's not there, right? Make no bones about it. Not because it's not there, because most of this is complete nonsense. They make money when they raise money. That's where they make money, because they take a spiff off of it, 1%, 2%, whatever their money raise commission is. Then they're taking a little bit of the cash flow, meaning the management fees. And then on the back end, they're getting a little bit, right? Nothing wrong with that way of investing, but 99.9% of investors would be much better off doing smaller properties because there's a lot more profit because there's more of them. You can find a lot of deals because there is more quantity of smaller properties that are available. So that's, hopefully that makes sense. What are the resources that you used when you started? Any books, videos, define your approach. So when I started, now you got to put this in perspective. When I started, this was 2008 is when I bought my first property. At that time, you did not have people putting YouTube, or YouTube University did not exist, right? You just didn't have that. So the books that like I had read, like most people, was Rich Dad, Poor Dad. I had read No Money Down. I'd read a bunch of those types of books, but I had never gone to, in my life, to a quote unquote investing seminar, right? I had decided I was going to do exactly opposite of what everybody else does. What does everybody else teach in real estate? Like, while I think the cash flow book, right? Cash Flow Quadrant or Rich Dad, Poor Dad, phenomenal books. The idea behind it makes perfect sense, right? I personally, this is just me, I don't agree with the fact that all the time you should take on greater and greater debt, right? Do I have a lot of debt today? 100%. But I have a lot of liquidity and a lot of cash. And here's why I'm saying what I'm saying. A lot today, I see this more than ever, right? OPM and blah, blah, blah. And all of that is great, right? You need debt to scale. You need debt to be able to start buying properties. But this idea of equity stripping every single one of your property and keep scaling up will get you in trouble. I promise you it will get you in trouble. So the approach that I had used initially was simple. At the time, I didn't have a lot of cash. I took $20,000 of home equity loan on a townhouse I used to live in. I still own the townhouse. And then I had a friend of mine, he put in 20,000 bucks. I took that 40,000 and I used that as a down payment towards a flip. I did that flip, then took the total profit, reinvested again in 2 flips. Then took the profits from 2 flips, reinvested into 4 flips. Then it went to 8 flips, then 6. Now, the process that I followed, here's the mistake I made, and I'll be real brief. The mistake that I made was I quit selling real estate, which was my way of making a living, right? Was I made money by selling real estate. What I should have continued doing was I should have stuck to doing maybe 1 flip at a time, not doing this many flips, because I'll tell you this, that of the first 100 flips I did, right, on about 30 flips, I made about $45,000 per flip. On the rest of them, about 60-some flips, I made less than 12 or 13,000. Right? And this is the reality. Anybody who tells you around the country that, oh, every flip they do, they make 50,000 bucks and they do 100 flips. If they do 100 flips and they're making 50,000 bucks per flip, then at the end of the year, they should have $5 million cash in the bank. And then they would be paying taxes on $5 million bucks. If they don't, it's complete BS. Complete BS, right? And I know a lot of people who claim, oh my God, we do these big flips, blah, blah. Okay, great. What do you have to show for it? Right? It's that simple. See, if somebody drives Uber and let's say make $60,000 and somebody is a doctor and let's just say they make $300,000. At the end of the year, if somebody making $60,000 or $300,000, if they spend all the money that they make, how's broke spelled? Broke is spelled B-R-O-K-E for the Uber driver, and broke is spelled as B-R-O-K-E for the doctor. There is no difference. The doctor is not any better off than the Uber driver. Why? Because they are both broke at the end of the year, right? If you spend every single thing that you made, you're completely broke. So my approach was that after doing a bunch of flips for 3 years, I kind of switched. I said, I'm going to basically do a few flips because I have to, but I'm only going to do flips where I'm going to make minimum of 35 to 40,000 every time, right? And I'm not going to go try to flip every property I get. I'm going to pass on more properties, and the ones that I think there's a little bit of juice in it, I'm going to just wholesale it. So at least I'm making some money for just wholesaling it. Rest of them, I'm going to do flips. And for every 2 flips that I do, I'm going to keep 1 rental property. Every 2 flips, 1 rental. 2 flips, 1 rental. And I continued that scenario until I could do 1 flip and 2 rentals, 1 flip and then 2 rentals. Then it became 1 flip and 3 rentals. Then it became 1 flip and 4 rentals, right? What was happening was the stack that was coming in of cash flow was growing every single time, right? So today I have about 110,000 or so that comes in every single month. Now that's not counting all the new Airbnbs that I'm buying, right? All of those, obviously they make a lot of cash. This is just the cash flow from rental properties. With the Airbnbs, just in Chicago, I'm trying to get to 75,000 as quick as possible a month after expenses. Because what my goal for me, and this may not be yours, which is okay, is 250,000 a month. How can I make 250,000 in net cash flow every single month? I challenge you this. Show me a guru, right? Show me anybody that will show you $100,000 coming into their bank account net, not gross income, net income every single month. Guys, it doesn't exist, right? There are very, 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 very handful of people. Why? Because everybody gets caught up, oh, I'm going to build a wholesale business. Oh, I'm going to build a flipping business. There's nothing wrong with it. If you choose to build a treadmill that you're going to run on as fast as possible, go right ahead. See, I don't choose to do that. I choose to own treadmills that other people are running on. So the approach I had used was I want to be basically liquid in terms of having cash available so that I can basically build up. So I used flips to build a little bit of cash. Then I used other people's money, money from the private money lenders to be able to start building up rental properties, refinance them, pay the private money lenders back. And I've continued to put more and more and more and more rentals on the side. I've used a very old-fashioned approach, which is I don't want to have a debt all the time, meaning on about 15 to 20 rentals, I want them almost no debt, right? Almost no debt, because I believe this, that if your monthly expense is 10,000 a month, let's say, for you to live on, then you should have 12 or 13 rentals that are completely paid off. Now, beyond that, whatever you have, you can basically go put as much debt on it, play with it all you want, build, scale, do all the things possible. But what I believe is the amount of money you want coming in every single month, take those sets of properties, pay them down rather quickly, right? And put a 30-year debt on it, and then pay it down as if you're going to pay it down in 10 years. Take the extra cash flow and you do the 2-5-7 method, 2 years, 5 properties, get them paid off in 7, right? So that you have enough properties so that good economy or bad, you don't have to worry about it. That's the approach that I used, and that's the approach we try to teach in Mastery, right? That be in a position where you never have to look back. There's no point you basically doing a lot of flips, you're building all this rental business, and one fine day the market changes, now you find yourself in trouble. I don't believe that's a wise way of building real estate. That's just me. So hopefully that helps. What areas are good to invest in? Where would you recommend, the north side or the south side? So it's a tough question, right? But here's what I will say. North side, as long as you can buy good value. So here's how I would look at it. If you're in the north side of Chicago, right? North side, everybody knows that 90 and that quarter kind of, north part of Chicago, your northwest side of Chicago, which is all the suburbs, whatever. You buy properties that are in A areas, obviously you can't go wrong as long as your numbers are right. You buy B areas, you can't go wrong. You cannot go wrong because as long as the numbers work out, right? Now, if you're in basically there are not very many C areas in the north side of Chicago or northwest suburbs of Chicago, right? Most are going to be A's and B's, meaning aspirational or bread and butter areas. C is going to be areas that have a little bit more challenges. D is an area that has too many challenges because the economy in that area is not doing well. People are leaving the area. It's going to be high on crime, all the factors that we know, right? So those areas, you're not going to find that many up north, or you're not going to find northwest side of Chicago. It just doesn't exist. Now, west side of Chicago, like Chicago City coming out, you'll run into pockets where you have high crime, right? Austin, middle of Austin being one of those areas. But there are peripheries of that are okay to buy. I mean, some of those areas are hotter than hot. North of North Avenue, it is hotter than hot. That's just how it is. So that's how I would look at it. Now, South Side is a whole different area, because South Side, you have the South Side suburbs. That's going to be completely different than South Side of the city, right? And there are pockets in South Side of the city because it's going to be block by block. That's Chicago's always been that way, and it's always going to be that way. Those areas, I feel, this is just my opinion, unless you know what you're doing, be very careful if you're going to do a flip in today's market. Why? Because interest rates have gone up, and in those markets, what the market that used to be a market, some of those, or they were supposed to be, quote unquote, they've gone suddenly from C's to A's. Those markets have flipped back to B's in the South Side. Markets that were C markets, right? Dalton I would call it a C market. I would not call it a D market, right? Dalton has been a very interesting market. It's always had a high amount of crime. It's always had a high amount of shootings, but there are pockets of Dalton that are great, right? This is just how it is. I mean, you flip, you duck, and it's like you duck and you flip. I mean, I've made jokes about this all the time, because literally I cannot understand. I mean, this is just me, there are shootings in Dalton, right? It's a well-known fact. So I'm not like saying something that's not well known. And yet it was one of the hottest markets to do flips. Today, if you look at it, the market has slowed down. You take South Holland. What a phenomenal suburb, right? People in South Holland have really taken care of the suburb. But in the last year and a half, there are more break-ins over there than I can tell you. Right? I mean, just what it is. I mean, be basically more tolerant of crime, be tolerant of stupid behavior. Guess what's going to happen? Right? There are going to be more break-ins. And this is not an issue of being, unfair to people, targeting people. But listen, if you are not going to be very, very tough on crime and people are breaking in, and this is happening not just one time, multiple times, this is happening in some of those suburbs, that affects what happens on the back end, because guess what happened? Interest rates went up. So those markets, like a market like South Holland, which was a phenomenally good market for flipping, right? That market has stalled a little bit. Now, I'm not saying it is not selling. It's selling still, but you're going to sell the same property 2 or 3 times. That's just what's going to happen. So these are things that we have to pay attention to. So if you're in the South Side or South suburbs, you need to look at the comps, and you need to look at the market times as to how long it's taking properties to sell, and what are the times from the property when it's bought to all the time that it's sold. Because literally in some of the South suburbs, you'll have a property hit the market, 2-3 days later, boom, get a contract. Contract falls apart. Again, you get a contract. Again, falls apart. Again, you get a contract. It falls apart. So it's just kind of one of those things, right? So you have to look at it from that perspective. Yet, having said that, some of the best opportunities today exist still in the South Side, right? So a lot of times what people think is, well, just give me a simplistic answer, Andrew, and I'm all good. Guys, listen, if it was that simple, everybody would be a multimillionaire. This is about due diligence. It's about research. If you're buying the property at the right number, which is real estate 101, still, it is a great time to do flips. It is a great time to own rental properties. It is a phenomenal time to do Airbnbs. Why? Because there is that much opportunity. And this is something that most people don't understand. Guys, today, you have more cash flow, right? For me today to get to, 20,000, 30,000, 40,000 in cash flow is a lot faster than it was in 2008, 9, 10, 11, 12, 13, 14, 15, 16. Why? Because the financing tools available are higher than ever. The midterm rentals, which nobody had heard that term. Nobody had heard of Airbnbs, right? Nobody had heard short-term rentals. That was not a possibility. Today, right, the cash flow possibility is higher than ever. The question is, do you know what you're doing? If you don't, show up to the 3-day, participate, be a part of this. Next one was a property that I was talking about was, this is the property today that I had put up in Mastery, and this is that property, right? This is an MLS deal that came up on the MLS, and I thought it was a good opportunity. I went over there, looked at the property, and I had submitted a contract. The contract got accepted. So here we go. So I want to kind of go through this. Okay, here we are. So here are the numbers on this. So all in cost. So the purchase price plus rehab on this property and everything is going to be coming at about 185, right? The back end value on this property, I'm saying about 240 to 250, somewhere in that ballpark, give or take. It may be come in at 240, it may come in at 250, it may come in 235. But when we look in Mastery at the numbers, we look at for three things. We're looking for number one is what is the equity in the property that you're going to have once it's all said and done. And we're looking ideally, the best part is minimum 25 to 30% is what we look for, meaning you should be able to refinance every penny out. In this property, that is not going to happen. But still, we're doing the analysis because this is something for you to think about. Is this still a good deal, right? Second thing we look for is, well, what is the cash flow, right? Why am I buying the property? It needs to make cash flow. That's the second thing. And then third thing that I'm going to look for is that does it have my DCR, debt coverage ratio, right? So this property, I'm going to tell you off the bat, is going to be a little bit too tight to do a flip on, right? I don't think this is a property that, I mean, will you make some money? Sure. Will you make a lot of money doing a flip? No. You're going to maximum make about $25,000 to $28,000 if you do a flip on this property, right? You'll make some money. You're not going to lose money on this property, but on a flip, that's all you're going to make, right? Now, how about Airbnb, right? Airbnb or short-term rental, could you do that with this property? Yes, you could. The occupancy rates in that area, I think, are going to be somewhere around 55 to 60% occupancy rates. So not necessarily the highest occupancy rates from all the research that I've done. What about midterm rental? Well, you could do midterm rental, but I think you're going to be in a similar situation like a kind of a Airbnb and a hybrid. And some months are going to be good, other months are not going to be as good, right? But what about for a rental property? So the all-in cost in this, which is your purchase, the other cost in it, is going to be somewhere around 185, right? 240,000 is what I'm estimating back-end ARV on a 75% refinance, right? And if you go to a local bank, so the way I would refinance this is I would not go to a hedge fund. I would not go to a commercial hedge fund for a refinance on this. I would go and get a refi at 6.5% or so, 6.2 or so from a small bank that is local, right? One of the credit unions, that kind of stuff, because you'll save a little bit on the interest rate. $2,000 is your rent approximately, and your mortgage amount is $168,000. So in this property, you're going to have $17,000 invested in the property, right? That's what you're going to have invested. Now, you're going to have pretty good equity in the property. So let's look at what's the equity. It's 23%, right? What is the equity ideally we want? Minimum of 25. So equity-wise, we're a little shy, right? But let's look further. Now, what is our cash flow on the property? Cash flow every single month is $621 after expenses, principal, interest, taxes, insurance. Every single month, this property makes $621, right? Now, what is our cash on cash return? What does cash on cash return means? Hey, I invested $17,000 in the property. Every single month, it makes me $621. So what does that mean? Every year, this property makes about $7,400. I mean, imagine if you put $17,000 in the stock market, and every year you're getting a return of $7,400, right? Year after year after year after year. Here, not only are you getting that return, but each year your property's paid down a little bit. Your tenant is running on the treadmill to pay off your property, put money in your pocket. Not only that, you get depreciation, you get all the tax advantages of the particular property. Now, in terms of the last thing we look at, so cash flow is clearly great, right? The last thing we look at is what is our DCR, debt coverage ratio, right? If you ever want to retire with real estate, the one thing you have to always watch is what are your DCRs, right? If your DCR is 1.33 or higher across the board on your properties, guess what? That is something that you can retire on, because now the banks will continue to give you loan after loan after loan after loan as long as you keep your DCR at 1.33. In this case, we're at 1.59. It's a phenomenal DCR number, right? So for somebody who says, well, Andrew, I just have no money, right? This property is not going to work. Why? Not because it's not a great property. It's a phenomenal property. But they're going to have some money invested in this particular property, right? That's why it's not going to work for them. Not because it's not a good property. It's a great property. But for somebody who says, I can leave a little bit of money in the deal and still the property will make money because they have a little bit invested, but every single month the property will make money. In fact, the rate of return, cash on cash rate of return on this is close to 43%. I mean, can you imagine? 43% cash on cash return on the property. So this is a property that I offered it to Gold and Platinum Mastery, and I think a bunch of people want it. So we will basically, who are first in line, you'll get it. Miss Rosa, actually from Mastery, had looked at the property. She's like, Andrew, I had looked at the property, but so if other people don't want it, I'm in line. But Ms. Rosa is somebody who's an experienced investor, so we want to give somebody who's a little bit newer from Mastery a chance if you want to buy it. But this is something you got to commit to it and follow through. Having said that, hope you guys enjoyed today's Q&A session. Again, if you're not a member and you're just watching this on the web, for cash flow investors, make sure you become a member. And what our goal is, invite your friends, invite your family, and have them be a part of it. Because remember, the person who invites the most people and people that join the Cash Flow Investors, we're going to do a drawing. And obviously, if you've invited a bunch of people, you have the highest odds of winning. So make sure you invite. And it's 2 tickets, airline tickets, and that we're giving away this time. So thanks a bunch. And we'll talk to you on Wednesday.